Good morning, and welcome to Legacy's 2021 Market and Economic Outlook discussion. A very special welcome to our current clients, as well as our future Legacy clients that joined us this morning. I'm Candy Thurs, and I joined the Legacy team in October of last year. I'm based in Wausau, and I'm leading our growth and expansion efforts in Central Wisconsin market, along with the support of a great team of almost 40 other wealth and investment professionals here at Legacy. I'm also your host for today's event. On behalf of the entire Legacy team, welcome and thank you for joining us this morning. For today's call, all participants are in a listen-only mode. We encourage each of you to ask questions during today's webcast. You'll be able to ask questions by typing them into the question and answer chat box located on your computer screen. We'll do our very best to answer all of your questions today during our webcast, but if we're not able to get to those, we will reach out to you after the event to make sure that your questions are answered. We're also recording today's event, and the recording will be available on our website in the next couple of days, so it'll be available for you to view if you choose. Finally, if you experience any technical issues today during our discussion, please email us at marketing@lptrust.com. Again, marketing@lptrust.com. Today, we're very pleased to have three members of our investment team to lead our market and economic discussion. We have Nick Carver, our Director of Investment Services, who was also a founding officer when Legacy started business back in 2004. We have Greg Hansen, our Senior Portfolio Manager, along with PJ Schaefer, our Portfolio Manager. We have a fantastic investment team, and I look forward to hearing from them on their thoughts on the economy and the market. But before I turn it over to Nick and our investment team, I'd like to introduce Brenton Teeling, Vice President of Client Services and Administration here at Legacy, to share a brief history of our company along with other highlights from our organization. Brenton?
Thank you, Candy, and good morning, everyone. As Candy mentioned, I'm Brenton Teeling, Vice President of Client Services and Administration here at Legacy. I want to thank you all for joining us this morning. As I reviewed the list, I know that there are some people with some familiarity with Legacy and maybe some others that are joining us for the first time. So I wanted to take this opportunity and just briefly share with you for a few minutes a little bit about Legacy, the story of our company, and who we are as a team. So as you may have been aware, we celebrated our 15th anniversary here during the pandemic. And so we are in our 16th year of business after being founded in 2004 by a small group of trust professionals from a couple of different regional banks and trust departments, including our founders and our current president, Mike Mollick, and our current executive vice president, Joe McGrain. In addition to Mike and Joe, most of that original group is still part of the Legacy team. And over the course of the last 16 years, we've seen the addition of many talented and key members to the staff. A few people on this call probably remember back in 2004, starting with 0 clients and 0 accounts. And of course, over that time, we've now seen tremendous success and seen that growth to nearly 500 clients and just over $1.5 billion in assets under management. Now, of course, that tremendous business growth has also seen us expand our geographic footprint. We've expanded from our original headquarters here in Neenah across the state with offices now in Oconomowoc, in Madison, and Wausau as well. Now, all of that business growth and geographic growth has only been made possible by the depth and quality of the team that we have assembled here at Legacy, coupled with the extreme pride that we take in servicing our clients with a superior quality, customized, caring level of service. You will find that all of our clients work directly with a portfolio manager as well as an administrative officer. And that team is supported by an exceptional group of people from both an administrative support, an internal operations team, and a tax group here at Legacy. So before I turn it over to Nick to lead off our program, on behalf of our entire team, I just want to thank you for spending a few minutes with us this morning, learning a little bit more about Legacy. Of course, we would be happy at any point in time to tell you more about us and how we may be of service to you. So thank you again for joining us. And with that, I would like to introduce our Director of Investment Services, Nick Carver.
Thank you, Brenton. Again, I'm Nick Carver, and I've been here, as Brenton mentioned, since the beginning in 2004. And I have to say that last year, while perhaps not the most difficult year in the investment markets, 2008 certainly takes that trophy. Last year was probably the most challenging year in terms of the mismatch between reality and expectation. If you go back a year ago from right now, if we were doing this call, here's where we would have been. We would have seen the economy looking like it was set to take off. We had just cleared the impeachment of Trump. He looked like he'd be a shoo-in to get reelected because of the economy, 50-year low unemployment, especially all-time low unemployment for minorities. You may recall we had just cut a deal with China to ease the trade war that was going on. That was the expectation in 2020. Well, what a difference a year makes. Here we are a few hours away from the inauguration of a new president, Biden. And so we're dealing once again with expectation versus reality. And that's the secret to investment success, is how you handle expectations and reality as they present themselves. So hopefully we'll give you some tools today. At least we'll give you our expectations. Hopefully we won't come back a year from now and have a repeat of 2020. But we'll be laying out today 3 different areas of expectation we have of where we currently are and where we think we're going. And with that, I'll turn it over to Greg Hansen and PJ.
Thank you. Good morning. My name is Greg Hansen. And I think what we'd like to do today is just share with you some of the conversations that we've had with clients over the last handful of months. Going back to around the election time, as Nick referenced, we've had a number of conversations. People are concerned. I would say the majority of client conversations have been more concern than optimism about what the future holds. And as we sat down as a group and assessed where those concerns are coming from, really seemed to fall into 3 different buckets. And so those will be the main areas of our conversation today. Those conversations, if the presentation advances, there we go. Those general areas are the economy. And as we look at that, we see roughly 75 to 80% repair of the damage that was done back in the springtime of last year. So we're definitely not all the way back, but we are on the right track. And we expect to see continued improvement in that area with the vaccine rollout and a return to normal as we go further into 2021. The second area is the markets. And I think the main question we're getting there is, if the economy isn't back to full health, how can the stock market in particular be at all-time highs? And the way we respond to that is that the markets are a discounting mechanism. So they tend to look 6 to 9 months forward at where economic activity is likely to be at that point, rather than reflecting exactly what's going on in the economy today. What we're seeing in the equity markets is that the equity market breadth is very strong. That means there's very good participation. It's not just a few companies at the top that are leading the indices. And as we go forward here into 2021, we're expecting to see more pro-cyclical groups take the leadership rather than the defensive names that were leading in 2020. And as we look at fixed income, really we don't see much attractiveness within that space. Interest rates are still very close to all-time low levels. And we do expect rates to start to rise here in 2021 as the economy reopens and we see the potential for a little bit of inflation down the road. And then the third area, obviously there was an election in November, and there were some changes in Washington as a result of that. People are very concerned about what the new policy that will be from the new administration, how the changes in the House and the Senate may impact that as well. And so we'll talk about that. We look at the idea of tax and spend. Traditionally, there's been maybe a stereotype around Democrat politics that you'll see taxing and spending. And as we look at that, we expect to see spending first and then taxation. So we do expect both, but spending coming first, and the stimulus or the spending portion of that is probably going to outweigh what we see in tax increases. So with that, we'll jump into some economic indicators, and I'll turn it over to PJ.
Thanks, Greg. You know, I think if we were to take a survey of just the average investor and ask them, you know, compared to where we were in the pre-pandemic level to where we are today, you know, how far along is the economy on that road to recovery? I think the answers that we would get back would actually be pretty negative, and to Nick's point, expectation versus reality, not exactly the reality of where we are today. So we want to talk a little bit about unemployment, GDP or gross domestic product, and disposable personal income. You can see all those indicators have recovered roughly 70 to 75% of their pre-pandemic levels. Now I want to take a second and talk about unemployment. Nick mentioned this in his introduction. That unemployment of 3.7% was not just a good number. It was the best number we have had in 50 years. Now, from that, during the lockdown recession, we had unemployment peak at about 14.8%. Since then, as of last reading, unemployment is about 6.7%. So we've recovered that by 73%. Now, are we going to get to that 3.7% sometime this year or even into next year? Maybe, maybe not, because that number is such a monumental number to get to. But we do view unemployment trending in the right direction, and we think that's going to continue. As vaccines continue to roll out through this year and we get closer to that herd immunity, we think closer to the end of this year and in particular the fourth quarter, we'll continue to see that unemployment trend the right way. Now, if you look at the bottom line, that consumer confidence, consumers are really important. In fact, consumers make up 70% of our GDP. Now, pre-pandemic levels, you go back to what you were thinking about as a consumer, unemployment was really low, the economy was humming along, people were engaged, people were spending money. That consumer confidence score was right around 138 pre-pandemic. Now, during that lockdown recession, consumers, understandably so, became very nervous about the economy, very nervous about the market, very nervous about their paycheck. As a result, you saw consumer confidence drop to about 85.7. Since then, we've recovered in consumer confidence about 5.6. So it's interesting to say that GDP has rebounded 74%, yet the consumers and consumer confidence has only rebounded 5%. And consumers make up such a big piece of GDP. So for me, when I look at this data, what it tells me is, if I'm looking for something to propel this economy forward along this road to recovery, well, it's absolutely going to be led by the consumer. And what's going to make the consumer feel better is more vaccines and closer to herd immunity, something that we're going to get to closer to the end of this year and in the fourth quarter. So with that, I'll turn it back to Greg, and he can give us some more durables and non-durables information.
Sure. So as we look at what the consumer is spending on, as PJ mentioned, that's the biggest piece of the economy. Let's focus where they're spending their money. And really that personal consumption expenditures is broken into three separate areas. Durable goods, items that you expect to last 3 years or more. Think computers, cars, appliances, things of that nature. Non-durable goods, so still goods or products, but designed to last 3 years or less. And then services. So things like going out to the ball games or traveling, restaurants, dining in restaurants, leisure activities, concerts. And what we've seen here, the durable goods started at 1.5 trillion in the fourth quarter of 2019. At the worst level last year, those were still at 1.5 trillion. Very slight decline, and now we're up to 1.75 trillion. So if you look at that in isolation, you can make a case that we're already seeing a new expansion in the economy in durable goods. That's a positive. Same thing with non-durable goods. 3 trillion pre-pandemic, down to 2.88 at the low point, and now we're at 3.1 trillion. So again, another new expansion from the goods side of things. But with consumer confidence low, and people just not comfortable going out to all these events where they may encounter other people, the services side is what we really need to see come back around. If you look at the services sector of personal consumption expenditures at roughly $10 trillion and compare that to the goods side of it, added together roughly 5 trillion, it's about a 2-to-1 ratio there. So you can see the impact that the consumers will have on this entire equation. The service side of this is only back up about 58% of what we lost during the pandemic. So as PJ was saying, when we start to see consumers feel confident going out as the vaccine rolls out, we would expect that to be the big driver of the economy. And looking forward, that's where we're starting to see some participation within the equity markets, is in those types of stocks. As we look at the markets, I think one of the discussions that we've had here more recently is that the markets are not the economy is not the markets. As I said earlier, the stock market tends to be a discounting mechanism of economic activity. So this graph looks at two different elements there. The top clip is the S&P 500, so the largest 500 companies in the US. And the stock market there, as measured by the S&P 500, is now back to all-time record highs. The bottom clip looks at the year-over-year change in GDP growth. And as you can see, the recession that we had back in March of 2020 was the sharpest on record. I think it's worth noting that the graph that we're looking at here goes back over 60 years. So this is not just a short-term event that we're considering. This is a very significant downturn in economic activity, down almost 10% in a single quarter, year over year, annualized. That started to recover a little bit, but we're still not in a strong economic growth level. These are third quarter numbers that we're looking at. We should start to see fourth quarter 2020 numbers roll out at the end of January of 21 here. So a couple of weeks away. We would expect to see continued growth in that metric. But I think the thing to look at here is the scoreboard over on the right. And what this is telling us is that when the economic growth year over year is weak, 0.8% or below, that's when you see the biggest gains in the stock market. And that's the zone we're in right now. So there's the disconnect between the markets and the economy. When the economy is the weakest, stock market grows almost 15% per year. As this continues to improve on the GDP metric, we'll eventually get into a zone where we're between positive 8 and 6.1% year over year growth. We may even see some of that growth later this year as we drop off the March and April timeframe of last year and lap those numbers with new improved numbers from 2021. And as that's the case, stock market still does well, up over 7% per year, but not as well as it does when the economy is really in the tank. And when economic growth gets up above 6.1% annualized, that's usually the time where people feel good about investing, but it's the worst time to put money into the market. Markets actually tend to have negative performance when the economy is doing well. Oftentimes that can be attributed to the Fed coming in and trying to cool off the economy a little bit so that they don't have unintended consequences.
So to wrap up the economy with just a few more points, when we look at gross domestic product or GDP, if we look at the third quarter, that was tremendous growth. We had 33% growth. So we talk about being on the road to recovery. You don't get that type of growth without there being some type of recovery going on. Now, also to note, that was on the back of a very difficult second quarter. The economy contracted by about 31%. Now, if we take a step back and we look at year over year growth, you can see GDP is still down about 2.8%, right? Our view is that we haven't fully recovered yet, but we are on that road to recovery. Now, as Greg mentioned, we're expecting to see GDP growth numbers for the fourth quarter here at the end of the month. Me personally, I'm seeing estimates anywhere between 2.5% growth all the way up to 7.5% growth. So we're continuing to see that growth rate. With unemployment, again, I touched on unemployment. We're at 6.7%. We think we're going to continue to trend lower on that as more vaccines roll out. We may not get to that 3.7% number anytime soon because, again, that was a 50-year low number, but certainly trending in the right direction. A couple of forward-looking views. First, what can propel this economy forward? I already mentioned that it's the consumer. We saw consumer confidence just rebound roughly 5.6%. Greg mentioned that the consumer is spending money, but they're just not very confident. They're a reluctant consumer right now. As that continues to move forward, we think that will propel this economy forward. The other forward-looking view is inflation expectations. Now, we didn't talk a lot about inflation in the economy. We'll talk a little bit more about that in the fixed income presentation, but our view for inflation expectations is we think that they're on the rise, and they might actually be coming before most people think. The Federal Reserve has stated they're going to keep interest rates low through into 2023. Well, that may or may not be the case, but we think inflation expectations are going to be creeping up here in the shorter term. So moving into the markets, there are really two main aspects of the markets that we'll talk about. We have fixed income and we have the equity markets. Now I'm going to start talking about fixed income. Greg will talk a little bit more about equities. But when you look back at 2020, whether you're talking about fixed income or equities, the best place to start was the largest driver of the market, and that was the Federal Reserve, and in particular, the Federal Reserve balance sheet. Now, this is a chart depicting the amount of quantitative easing, or in other words, how much loans the Federal Reserve is putting on their books, how much bonds they're buying, dating back to 2008. Now, if we go back to 2008, the global financial crisis, we saw unprecedented monetary stimulus. The Federal Reserve added $1.4 trillion to its balance sheet. They went out and bought treasuries, then mortgage-backed securities, and they put that on the balance sheet. Essentially what they did is they made bonds look less attractive than stocks. Now that was over 16 months, again, unprecedented at the time. Well, if we look at what the Federal Reserve's response was to COVID, well, they added $3.2 trillion to the balance sheet, way more than what they did back in the global financial crisis. And again, what they did is they just made bonds look less attractive to stocks. Now, if you think about it, as the Federal Reserve is buying all of these bonds, the interest that bondholders are getting starts to compress. They're getting paid less to hold these bonds. So when you have a new investor coming to the market with money to put to work, are you going to invest in bonds where the Federal Reserve is keeping interest rates really low? In fact, the 10-year Treasury right now is right around 1%. Or is that investor going to look into stocks where you can get a dividend yield that's higher than the 10-year Treasury, so you're getting more income, and you also have future growth potential? Well, if you look at what happened over the last 9 months, those investors, they chose stocks. The S&P 500 since the March low is up over 70%. Now, the other thing, Greg, if we can go back one slide, the other thing to keep in mind is the forecast. When we say forward-looking, the Federal Reserve has been very transparent with what they plan to do. They have said that they are going to continue buying those bonds at the current pace, meaning they're going to continue to make bonds less attractive than stocks. That's why we think stocks can continue to churn higher this year. Now, if we move forward, just a quick recap of the yield and bond interest. So if we look all the way at the bar chart on the right, that tall blue line is just typically what a bond has returned over the last 40 years, on average about 7.5%. The dark gray line is the yield or the interest that bond has historically paid, right about 6.5%. So the majority of a bond's return usually has been the yield that you get. Now, over the last 40 years, that's been fine. You can buy a bond, you can clip your coupon and still do well, because if you look at the black bar, that's inflation. You're still doing much better than inflation. But as your eyes start to move from the right side of the page to the left side of the page, one thing is constant, and that's that dark gray bar getting smaller and smaller and smaller over the last 20 years, 5 years, and last year. The yield on these bonds are just not attractive. Last year, bonds did okay. You got a 7.5% return, but a lot of that was from price appreciation, selling stocks and buying bonds. Well, we don't think that's going to be the case moving forward. In fact, if you look at that solid red bar across, well, that's the inflation target of the Federal Reserve. So if we get to that inflation target by the Federal Reserve, which I think we get to, and yields don't come up, well, all of a sudden you're losing real purchasing power. So if we go on to the next slide, we'll talk a little bit more about inflation. So this is a chart of money supply and the velocity of money. That blue bar, or the blue line, is the money supply. You can see as we get into the recession on the right-hand side, money supply just peaked. It shot up. That's all the monetary stimulus and fiscal stimulus you saw. Now the red line, that's the velocity of money. What that means is those are just transactions. So I'll use myself as an example of what that is. I work for Legacy Private Trust. When I get paid, that money hits my bank account. That's one transaction. I need to go to True Value to buy some light bulbs, to replace some light bulbs in my house. Well, that's two transactions. Now, True Value needs to pay the cashier that rang me out and sent me on my way. So that's three transactions. That cashier stops at Starbucks on her way home. That's four transactions, and so on. But in a COVID world, that cashier, when she leaves work, is not going to stop at Starbucks. She's just going to go right home. So we have lost transactions, meaning velocity is down. So if you follow that red line to the recession, you see that sharp decrease in velocity. Now, in order to have inflation, you need two things. You need money supply and you need velocity. Money supply we have, and in fact, we're even going to get more stimulus. But what we don't have is velocity. So over the short term, we don't think inflation is going to be a huge concern. But think about when we start to get more vaccines rolled out. And I talked about how consumer confidence is going to pick up in the second part of this year. Well, we're going to have consumers out spending more money, making more transactions. So that's why we think inflation expectations are going to increase closer to the end of the year. We may not have runaway inflation, and that's not our view, but we think we're going to get some more inflation expectations. That's going to make fixed income less attractive, and it'll make equities more attractive. And I'll let Greg talk a little bit more about the equity portion.
Sure. Actually, before I get into the equities too much, I think one of the important things that you said, PJ, that ties in well to this next slide is the idea that the velocity isn't there. So if we've created all of this money, where is it going? And what we're seeing at this point, this is looking at the sum total of deposits and money market accounts, both institutions and retail investors. And you can see over on the right-hand side here, pre-pandemic, we were around just over $2 trillion of money market balances for institutions, another trillion or so for individuals. So the total was a little over 3 trillion. But when all the stimulus checks came out in March, that jumped up and we got up close to $5 trillion in money markets. If you look at where interest rates are right now, the chart that PJ was showing a minute ago with bond interest rates and yields on the 10-year treasury around 1%, that's if you're willing to commit your money for 10 years. Money markets, very short duration, very liquid securities, and so there's essentially zero yield on money markets. And if we do start to see inflation, and as we get the vaccines rolled out and people feel confident going out and spending money in the economy again, you're going to see a lot of pent-up demand. There's plenty of dry powder out there, money market balances, and this money wants a place to go. So we think they'll either spend it in the economy or put it into the stock market. And what's interesting here is when the stock market hit its low back in March of last year, that's when we saw the big increase in money market balances. And from that point forward, when the stimulus came back around and the shareholders in those companies realized that not everything was going to be shut down indefinitely, markets have recovered very significantly from that point forward. We expect to see this money market balance eventually start to work its way into equities. So looking at the S&P 500, one of the things that we're optimistic about is looking at the level of participation within the companies that make up the index. So again, the blue line at the top is showing the S&P 500, the 500 largest companies out there. And you can see where the bottom was in late March and where we've gone to from that point. What the orange line at the bottom is showing is the number of companies in what we would consider an uptrend. So we're looking at the average closing price of those companies for the last 200 days. Just take the price they closed at for 200 days, average those out, and compare that to the current price. And if the current price is higher than that average, that's considered to be in an uptrend. If it's lower than that, it's considered a downtrend. Well, you can see back in late March, really the only names that were in an uptrend were the real defensive names, things like Amazon. You're still going to need to have some things delivered to your house. Kimberly-Clark and consumer staples types of companies were probably doing okay at that point too, but the majority of companies weren't. And from that point forward, we've seen broadening of participation. Right after the election, that number spiked, and we've been around 90% of the companies out there are now in a defined uptrend. So there are still a few laggards, but this is about as strong as we would ever expect to see this number. And it's been riding at those levels for a couple of months now. If you go over to the scorecard on the right, you can see that once we get above 61% of companies in an uptrend, way down here where this dotted line is, that equates to around 11% per year annualized gains in the S&P 500. And we get that about half the time, 54% of the time roughly. So with what we're seeing out there, broad participation, that's telling us that there's already a lot of money coming into the market. We already see the size of the money market balances, and we think those will start to work their way into the markets, broadening the rally even further. So if we go back and look at where the performance has been within the markets, I think this is a tale of two different markets here. Really what happened from the lows in March up to election day, and then what's happened from election day forward. So the dark blue bars in the background are market bottom in March up until election day. And you can see the top performers in there are things like the materials sector. Well, if you look through that, of the top 10 holdings in materials, 2 of those are paint companies. Think about what everybody's been doing with their stay at home, work from home, spending on paint and other things of that nature. Technology, obviously everybody's increasing their technology spend so that they're able to stay home. Industrials, that includes companies like UPS and FedEx, rails, shipping companies, everything that's being shipped to you in your home, those companies did well. And then consumer discretionary. Up until Tesla was added here just recently, consumer discretionary sector was about 30% comprised of Amazon alone. So that explains why you saw the performance you did from the market bottom up until the election. Now, if we move from the election forward to the end of last week, the gray bars show you where the performance has been since then. And what we've seen, top performing sector has been energy. I think the thing that really stood out to us as we looked at this was the magnitude of the performance there, getting close to 50% return in about 2.5 months for energy. There's 2 different aspects to that as we see it. One is the reopening of the economy. People start going back to their normal day-to-day activities, and they're going to need to purchase gasoline. Same thing with airlines. As people start flying, they're going to need to purchase jet fuel. So energy companies are doing well there. The other side is the political aspect of it, where we don't expect to see as many permits being issued, making the supply a little bit more constrained going forward. Other top performers have been financials, and as the interest rates and yield curve have steepened, what we're seeing there is banks borrow from you and I at very low interest rates, and now the level of activity is increasing, but the interest rate that they're making those loans at is now higher as well. So their net interest margin, or the spread that the banks keep, is increasing. So the financials are one of the top performers since the election. And then other positive signs that we're seeing here, the Russell 2000. So this is small cap stocks compared to the S&P 500, where it's the largest companies. You're seeing smaller companies outperform. We're also seeing emerging markets and developed foreign markets perform well. So we're seeing a broadening, I would classify this as a broadening of the participation and diversifying into more pro-cyclical groups as we go forward.
So to wrap the markets up before we move on to politics, just to review a couple of points. So Greg talked about how there's excellent participation in the equity markets. We have broadening leadership. Those are major positives for equities. It's no longer just technology leading the way. Now we're having a transition to pro-cyclicals. You saw financials, energy, small cap stocks really starting to lead the way. In terms of fixed income, I talked about how fixed income treasuries in particular are not very attractive right now. The yields are really low. By default, stocks are becoming more attractive. In terms of fixed income, we think moving towards more of a risk-on environment is better, meaning we like high yield, we like emerging market debt, more so than treasuries. Those holdings can participate a little bit more as the economy recovers. So with that, we'll move right into politics, our last bucket of discussion.
Right. This is the third area, or the third leg of the stool, where we're hearing concerns from clients. And just to set the stage here a little bit, if you go back to the election or just before the election, remember that we had a Republican president. The Democrats were in control of the House, and they had a 36-seat margin there, so pretty strong control. There are 435 seats in total. And the Republicans had a narrow majority in the Senate. So we have mixed government. Generally what that means is that neither party can get too much done without some cooperation from the other. Jump forward to Election Day, and what we saw within the House of Representatives, the Democrats' margin of victory narrowed. So they lost a total of about 26 net seats, meaning that there's just less that they can push through along party lines. They still have a majority, they can still get it done, but it's less compelling from that standpoint. As the results are still, I guess probably not anymore, contested, but you've heard some challenges around the presidential election. It is pretty clear that Joe Biden is going to be president now. So we've had a transition from Republican to Democrat control. And so the Democrats retained the House and have the presidency. Really the one piece that was missing for them was the Senate. And if we look at the Senate composition, immediately after the November elections, there were 2 seats that were a toss-up or didn't have enough, a large enough share of the votes in Georgia. And so that caused a runoff election. Basically, going into that runoff election, this is the configuration of the Senate. There were 51 Republican seats, 46 Democrat seats. There were 2 independents who caucused with the Democrats, and then there was 1 vacancy. And really the 2 seats here, this was Kelly Loeffler's seat in Georgia, so it was controlled by Republicans at that point. And the second one was Perdue's seat, and that one was considered a vacant seat at that point in time. But really the Republicans had about 52 seats effectively, even though they technically only had 51. So in order to retain control of the Senate, they would have really needed only one of those 2 seats to fall in their favor. Jump forward, and both seats went to the Democrats in that particular case. So now we have 50 Republican seats, we have 48 Democrat seats, but then the 2 independents who caucus with the Democrats make that effectively a 50-50 split. And in that case, the vice president becomes the tie-breaking vote if for votes along party lines in the Senate. So you have now Democrat president, Democrat control of the House, and Democrat control of the Senate if it goes along party lines. And I think that's where some of the fear is coming in. There isn't really the gridlock or the need to cooperate anymore. As we look at this, we still don't think this is the most extreme outcome. It is a shift in the political landscape, but it's not the most extreme outcome that we could have seen.
So as Greg mentioned, the Senate can't be any more tight. 50-50 with the tie breaking going to the vice president. So we think it's a good idea that when one vote can really shift the Senate and the way legislation is done, well, let's look at how these senators have voted in the past. Now, this is a score of polarizations where if you see Elizabeth Warren all the way on the left-hand side, what that tells us is she's going to vote Democratic no matter what. If we go all the way to the right, when you look at Republicans, Dan Lee, he's going to vote always with Republican, never a compromise. So the Senate is really going to be won and lost in the middle ground. Now, Joe Manchin in particular. Joe Manchin has already come out and publicly stated that, one, he's not always going to vote along the Democratic Party lines. And in fact, if you look at his history, he voted with President Trump the majority of the time. Another thing he publicly stated is he's not going to vote against he's not going to vote to dismantle the filibuster rule. That's the most important tool that the Republican senators have. John Tester, a senator out of Montana. Montana is a red state. John Tester is a Democrat. He also has said he's not going to vote to end the filibuster rule. So again, these are two votes that could very easily swing to the other side. Now, you can also make the case that Susan Collins, the Republican senator out of Maine, which is a blue state, she historically voted with President Obama a lot. So you can make a case one way or the other that, you know, these votes can go across party lines. The big takeaway from this is no legislation is going to get through the Senate completely unscathed. So as we're concerned about this massive legislation that's going to change with spending and energy and things like that, well, it's not just going to flow right through the Senate. We are going to see a master class in negotiations in this Senate. The other thing to take away is if you look at Elizabeth Warren and Bernie Sanders, well, they wanted really prominent roles in this administration. Elizabeth Warren wanted to be the Secretary of Treasury. Bernie Sanders wanted to be the head of the Department of Labor. Well, President Biden went much more moderate and actually upset a lot of progressives with this. But instead of Elizabeth Warren being the Secretary of Treasury, that's Janet Yellen. Now think about the communication between Janet Yellen and Jay Powell. We're going to see fiscal policy and monetary policy work very closely. When you look at Bernie Sanders, he's not going to be the head of the Department of Labor. Well, that's going to go to Boston Mayor Marty Walsh. Again, much more of a moderate than a far out progressive. So, you know, I think the markets have taken solace in that. Again, we don't think legislation is going to completely pass through unscathed. It's not going to be a free-for-all for the Democratic agenda. And with that, I'll let Greg wrap us up on politics.
Sure. I think that, PJ, what you've said there is really important. There isn't a clear-cut answer to the way the political landscape is going to come through. And at this point, we really don't even have a lot of specifics about what the proposals are. As with any new administration, we expect that there will be some changes, some companies, some industries more specifically, that will be winners and others that will be losers, but we don't have enough clarity around there. We have a rough idea, but nothing is certain at this point. Before we even really start to debate the various policies that are likely to come, we think it's most important that the virus get under control. Everything that we've talked about earlier in this presentation was about reopening the economy and controlling the virus. So until that's done, a lot of these political proposals really don't matter to any great extent. As we look at what will come from a spending perspective, as we said before, spending and then taxes, we expect to see stimulus payments going out, probably additional payments here before long if they haven't already hit, but those are likely just to build up in money markets because there's nowhere to spend the cash at this point for most people. And as we see those stimulus payments are important for lower earners within the economy, but not necessarily a durable boost to economic activity. They will have a short-term impact, but where we think the longer-term boost to economic activity will be is when we start hearing about infrastructure spending. So things like roads, airports, the electrical grid, but even more importantly, perhaps is a build out of broadband capacity nationwide, allowing people to do just what we're doing here, everybody work from home. Going forward, we do look at certain industries or sectors. Green energy, we expect there will be some noise on that front, and companies in that industry will do well. The industrials, as you get a reopening of the economy, some of these companies that manufacture vehicles and airplanes and things of that nature are going to start to pick up. Financials, for all the reasons that we laid out before, should be in pretty good shape here. Starting to see a pickup in economic activity and a steeper interest rate curve. And then a lot of the municipalities, I think they've been forgotten or haven't really been talked about to any great extent here. We are hearing that there could be the rollback of the cap on SALT deductions or state and local tax deductions, which would allow the municipalities to strengthen their balance sheets a little bit going forward as well. Again, all proposals at this point. And what's likely to be negatively impacted is probably traditional carbon-based energy. The oil companies, we just don't see a lot of new pipelines or drilling permits being issued by this administration. So likely a benefit for green energy, less so for traditional energy. And then retail and service industry. We've heard proposals of possibly a $15 minimum wage at the federal level. And if that happens, some of those service industries are going to have to find ways around that. They just won't be able to operate at $15 minimum wage, and we likely see some of those positions be automated or eliminated. So that's the wrap up from a political front. I think what we've done here is essentially built a fairly strong case that a lot of the fears that we're hearing are maybe a little overblown. We're not as concerned. I think we've laid out a pretty optimistic case for the continued improvement in economic activity as well as the markets, and maybe not as extreme a political outlook as some had anticipated. So with that, we'll wrap it up and move forward to the question and answer section.
Thanks, guys. First of all, PJ, I think we all enjoyed your example of money velocity post-COVID, but I think you missed something, and that is that you wouldn't have been driving home from work because you were working from home.
Yeah.
You just would have ordered your light bulbs from Amazon. So that just shows we had even less velocity than we thought. And I think also there were a couple, you know, Wall Street loves acronyms. You know, we love coming up with things. And, you know, the two that really are kind of defining what's been going on is one is TINA, T-I-N-A, which is there is no alternative. And that's basically what's going on in investors' minds right now is where do you invest your money? And Greg said, ironically, what they've been doing is they've been investing it in the lowest yield possible, which is money market. The other acronym is FOMO, which people use in a lot of areas, but in investing, fear of missing out. You know, we're seeing a lot of that happening in investing. And I think that's a little bit worrisome in the short run that people have, you know, it's at least a certain segment have been afraid that they miss out. Now, at some point, the market surges higher, and then that'll bring a lot of that cash in. Just a couple questions here. And I'll send this one to Greg. It seems like a lot of what we're saying is going to determine the future of the investment markets is the Federal Reserve, and they're being accommodative and I think basically driving people into risk assets. How will we know when they're ready to flip the switch? Because we can see that that when that happens, things aren't so good.
Yeah, that's more of a process than an event. And what we've seen from the Fed more recently here has been much more transparency and much more communication. Most recently, if you look at the rate hiking cycle that we saw, I believe it was 2017 into 2018, their timing isn't perfect, and they'll tend to tell you on the front end that it's going to last much longer than it will. In fact, I want to bet with PJ on this, and he still owes me a lunch, but we'll come back to that later. But basically, at that point, the Fed was saying we're going to hike rates every quarter for some extended period of time here, and until they didn't. I think it was 6 weeks after the last statement of that sort that they had changed their policy to neutral, and not too long after that, they were effectively cutting rates. So there will be a little bit of a lead time and a little bit of warning there, but until or unless it looks like they're going to be less accommodative, certainly don't want to fight the Fed. They have the biggest balance sheet in the world and the biggest, I guess they aren't really printing presses anymore, but they can create more money electronically than any other source out there. And so as long as they're telling you that they're going to support the economy and effectively that money has to go somewhere, we think it continues to go into the markets. If and when they change direction, we'll want to pull back on equity exposure at that point.
And one last question, PJ. If bonds are so unattractive, what's an investor supposed to do who needs income?
So you do have to take a look at when you need to have that income. And even though I make the case that bonds are really unattractive for the short term, well, you certainly want to have some type of bond exposure in your portfolio. Because one thing is for certain the rest of this year is we're going to see bouts of short-term volatility. And so if you're an investor that needs to rely on a portfolio to generate income for you to live off of, well, you certainly want to have pieces of your portfolio in fixed income that you can pull off of it in terms of need. Now, when you look at equities, there are obviously a lot of equities that can also derive income. So if you have a longer time horizon, well, you can still let that money ride in the ups and the downs of the equity market and still participate and still collect some of that dividend with equities. So in terms of where you can get dividend or yield, you can actually get them from both. It depends on your time horizon for investment.
Very good. Well, thanks, guys, for your presentation and for fielding these questions.
Thank you, Nick. Thank you, Greg. Thank you, PJ. And thanks to everybody for joining us today. We've hoped you've gained some insights from listening to our team's analysis and thoughts on the market, the economy, and the current political environment. If you would like to continue today's investment-focused discussion, we're always happy to do so. And we're also happy to assist with any wealth planning, business succession, trust administration, or any other way. We have a talented group of professionals here at Legacy that can assist you with most all of your wealth planning and investment needs. If you would like to contact us, the information is up on up on your screen. You can email us, or you can visit our website at www.lptrust.com. All of our professionals are listed along with our contact information. So please reach out to us if we can help in any way. We look forward to seeing you at one of our future webcasts. We'll be doing our market and economic webcast on a quarterly basis. And in March, we'll be kicking off the first in a series of Women in Wealth webcasts. The Women in Wealth webcast will be focused on topics specifically that our female clients say that are most important to them and their families. So we hope you'll be able to join. Again, thank you for joining us this morning. We appreciate it and have a great day. Thank you.